makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, in for Francine Lacqua. Here's what's coming up on today's program. Societe Generale slumps the most in 6 months as the CEO's first strategy update underwhelms investors. Meanwhile, oil pushes closer to $95 a barrel as OPEC Plus supply cuts squeeze the market further. Plus, stocks fall as traders stand by for a big week of central bank decisions from the U.S. to the UK and, of course, Japan and around the world. Let's start off the show by taking a quick look at the European markets map. You are seeing quite a bit of movement, but a little bit of red on the screen. Now, a lot of the sentiment is going to be coming from Asia. I think the real underperformer here is going to be in France. The CAC 40 really taking a hit here. That's going to make a lot of sense as we talk about which economies are going to get hit hardest by the ECB. Of course, you are seeing a pullback in the DAX as well. And, of course, the FTSE 100, though, not as much action. That's going to be significant, again, as we talk about the read-through from the BOE. We hear from them later this week. But, again, the real underperformer comes from France. The Euro Stoxx 50, I should say, as a whole, down about, we'll just call it 0.3%. So that's going to be your market map for you. But, look, it all comes down to central bank decisions right now. Let's take a quick look at the Federal Reserve here, because this is really going to be the tone setter for the rest of the week. Pricing already suggesting that if we do get a hike, this might just be the last one. Maybe the 2-year saga that we've had for the Federal Reserve, well, this is the end of it. And this is really what that chart is showing. At the core, though, what is driving inflation? I want to bring it to my next chart, oil and bonds. We're talking about oil hitting $100 a barrel. Does that actually spark inflation? Remember when we were just amping up the inflation story in 2021, bond yields following the oil market tick by tick? That no longer seems to case. As we start to see oil's rally really strengthen, bond yields not following the same story. It really tells you that perhaps inflation won't be driven by the commodity story. Where will it be driven by? Wages. At the core of it seems to be the labor conversation. And it's not just about payrolls anymore. It's about the global story about just how much labor actually costs. This chart is one of my favorites here, because, of course, we are fully following the United Auto Workers strike. But take a look at this. Auto workers, essentially the backbone of Detroit's economy in the United States, the assigned auto working industry, is actually taking a way bigger hit than all of its peers in some of the manufacturing sector. That is going to change. What does that mean for the end consumer? Net, what does that mean for inflation? That's going to be a big story from the economic perspective, but also from a financial perspective. That's going to be something that, as we start to see priced into the markets, might benefit some of the banks and the way they are trading very specifically. So, again, keep your eye on what the banks really take their cue from on that, at least on the front in the U.S. front. Here in Europe, you're already seeing a little bit of mixed reaction to the banks, a lot of it coming from SocGen. Shares slumping the most in 6 months this morning as cuts to revenue and profitability targets underwhelmed investors. Let's get to Bloomberg's Caroline Conan in Paris. She is all over the story. Caroline, walk us through the strategy update from this morning.
Could you remember a few hours ago we were saying that we didn't see anything spectacular in this strategic update in terms of numbers, in terms of new targets, only very slight changes? Well, clearly investors are also disappointed. The shares opened minus 7% for Societe Generale. Clearly not very good when it's a new CEO, Slawomir Krupa, who is presenting his next strategic update after 15 years of the previous CEO, Frédéric Oudéa. So clearly here he wanted to focus on cutting costs and limiting the risks, for example, on risks-weighted assets. But clearly that has kind of outweighed the problem that you have with the average revenue. The average revenue growth new target is between 0 and 2%. It was 3% before. This is a disappointment for investors. Also a disappointment in terms of the profitability target, with the return on tangible equity slightly lower. And finally, a disappointment on dividend payouts. The payout under the Frédéric Oudéa as CEO was 50%. Now it's between 40 and 50%. So investors are not expecting a high payout with this new CEO. Already, SocGen missed out on their 50% target last year due to the big €3 billion hit they had in Russia. SocGen was one of the most exposed banks in Russia. So a disappointment for investors. One BI analyst actually said that caution is outweighing growth hopes.
I mean, it's a really interesting dynamic, especially when SocGen is kind of lagging all of its European peers, not just its French ones. Caroline, how does it target this going forward?
Yeah, and if you look at the share price for the past 15 years under Frédéric Oudéa, they've actually lost more than 40% of their value, even if they've slightly recovered with the prospects of this new CEO, with the prospects of this new strategic plan since the lowest point this year in March. But the price-to-book ratio of SocGen is the trades at the biggest discount among European lenders, and it seems like this new strategic plan is not going to change much things, at least in the short term. One analyst is also saying that in the long term, the structural issues remain. Some other analysts are saying they wanted to see more restructuring at the investment bank. We'll see also if today, during the Capital Markets Day, which just started in London a few minutes ago, we will get more comments from Slawomir Krupa, more details, for example, on asset disposals. They've already announced the disposal of 4 units in Africa. They're reviewing another one in Tunisia. They're also reviewing the sale of their asset custodian unit. We'll see, we'll get more details to reassure investors throughout the day.
You know, Caroline, I always joke that you couldn't pay me to be a central banker. I got to say, you couldn't pay me to be at the helm of a European bank either. Caroline Conan with our update on SocGen from Paris. We thank you as always. And like I said, you can't pay me to be a central banker, yet some people still do the job. It's a massive week for central bankers this week. The Fed really takes center stage. The FOMC rate decision on Wednesday, the BOE in action on Thursday, and the BOJ on Friday. 3 different banks, 3 different spotlights, 3 vastly different takes on the global economy. Bloomberg's Zoe Schneeweiss joins us now for more. Zoe, let's start with the Fed here. So if we're not expecting a hike, what are we expecting?
So what we're expecting is some hawkish language regarding November. Overall, as always, the dot plot here is key, and Bloomberg Economics predicts that that will actually show another rate hike in November. But it is very close. And why is it so close? Firstly, the November 1st is the next rate decision. And before that, any data we will get are likely to be very mixed, not really showing a clear indication for a hike or a hold. And what makes things matters worse is that the United Auto Workers strike and a potential government shutdown, those events won't be showing in the data. So that makes it difficult. Overall, Bloomberg Economics does think that it's going to be another hike in November, but again, a close call.
I mean, it's a really interesting dynamic, again, because off the back of the ECB decision last week, we're already getting a lot of pushback from the fiscal authorities. I believe the best example I can give is that over in Italy, Matteo Salvini said Lagarde is literally on Mars. That's how much pushback there is about the effects of these rate hikes. Let's talk about the Bank of England, Zoe. Could we start to see the same pushback against Andrew Bailey as he's expected to hike?
So Andrew Bailey himself said earlier this month that the BOE is likely to be near the peak of its hike. So 25 basis points this week is almost certain. One thing here is the BOE will want to keep open that optionality to say maybe we're at the peak, maybe not. Just because in the current situation, central banks, if they cement themselves into a position that just does not work well and that doesn't give them the flexibility, quite honestly, that they need, and central banks are data dependent, and the BOE's comments are likely to reflect that.
Again, 3 different banks, 3 very different results, I imagine, in the back half of this week. Bloomberg's Zoe Schneeweiss all over that story. We thank you, as always, for joining us this morning. Coming up on the program, enough is enough. France's finance minister on the prospects of another ECB interest rate hike. We're going to bring you more from an interview with Bruno Le Maire. That coming up next. This is Bloomberg.
I always say I hope they get it right, because it's not so easy when you have so heterogeneous inflation rates around Europe. Spain, for example, has the lowest inflation rate right now at 2.4%, but other countries are proving to be much more resistant to lowering inflation. So I hope they get it right, and from the national perspective, I also hope they stop now, because our inflation rate is already quite low.
From a national perspective, what you say is a country like Spain does not need rates going above 4%. That's basically what you say.
Well, I think that this is a good summary of.
And you said two interesting things there. You said that there's a conversation about duration and the level of it. But I wonder if there was another hike, and the market does not believe that for the time being there will be another hike, but is there now a real risk that if you were to go tighter, this is now really going to send this economy into a recession? You're suffocating the European economy.
Well, again, it varies very much between the different countries. We were just starting our Eurogroup meeting here, as you said, in Spain, in Galicia, in my region of origin. And what we see is that the situation of the different economies is very, very different and very heterogeneous. Again, Spain is the strongest growing economy in the EU. It is projected to be the strongest growing large economy in the Eurozone next year. Again, the forecast is for 2.2% GDP growth year on year this year, after very strong growth in 2021 and 22. So in the case of the Spanish economy, the prospect and the forecast is quite positive. But indeed, there are some other countries that are slowing down or even having a recession, and that has an impact overall.
And yet, as a finance minister, you also know, however, you say your projections were upgraded on that. It's very fair, but when you look at the indicators, it seems there's a loss in momentum, and there is some kind of pessimistic take on the economy now, where some say we're heading into stagflation. Is that something that you say not so fast?
Well, absolutely not. I mean, when we're talking about 2.2, when we're talking about 2.2 GDP growth in the case of Spain after above 5.5% last year and the previous year, I don't think that would be an accurate word, to describe the situation. We're having quite resilient growth, strong growth in our economy, and inflation has gone down by 8 percentage points in 1 year. So I'd say that would not be a good description of the Spanish economy.
Our exclusive interview there with Spain's economy minister, Nadia Calvino. She's saying the ECB is probably done with tightening, speaking there to our Bloomberg European correspondent, Maria Tadeo. Let's stick with the theme of Europe and central banks. Joining us now, Raffaella Tenconi, founder and chief economist of ADA Economics. Raffaella, a pleasure to have you on the program. Let's start with what Nadia Calvino was saying. She's not alone in simply saying that, look, we are done with the rate hikes, at least from the fiscal authorities in Europe. Is that enough pushback, do you think, against the ECB to really register?
Hi, good morning. Well, I think it's a strong signal that indeed it hurts at this level of interest rate. I don't think it really changes the ECB's trajectory. I think a December rate hike is still plausible because the labor market is going to stay resilient. But it is true that interest rates are very restrictive, and willingly or not, the ECB is going to have to cut very aggressively next year.
What would President Lagarde actually do when perhaps revisiting some of the way that the ECB targets the European economy? Because, again, it's quite clear not all is created equal. If you were President Lagarde, what would you do, Raffaella?
So I think the consequences of keeping interest rates too high for too long in the Eurozone, it's first of all on productivity and investment. So Lagarde has already said she expects the second half of the year to be weak, but she expects 2024 to be a rebound. If she doesn't handle the communication correctly, then the risk is that invest for 4 quarters, and that has direct consequences on productivity long term, which eventually also hurts inflation. The other issue is also on the distribution of upside. So what we see is that, of course, if you're younger, energetic, or very large company, you're doing better. And then there are a large number of companies that are not as well equipped in the transition. So there is a distributional effect, which eventually also impacts productivity and social cohesion. So if I were Lagarde, I would frankly drop this data dependency communication, which is very 1980s, frankly. And I would upgrade the communication to reflect a more candid assessment of what is the inflation challenge, which is difficult. But just let's be clear, inflation in the Eurozone is coming down. It is going to be between 2% and 3% next year. So she doesn't need to be this aggressive, right?
I mean, at least that is the take from a lot of the world leaders. I read over the weekend, I believe, from Bloomberg reporting that the leader of the league in Italy, Matteo Salvini, calling Lagarde, saying she is living on Mars. So some real fighting words from there. I want to bring you some sound from the French finance minister as well, Bruno Le Maire. Take a listen to what he had to say.
I think that we are at the right level of interest rates in the EU to stop inflation and to reduce inflation. And this is the goal of these interest rates, to reduce inflation. We are on the right track. And I think, as Christine Lagarde said, that we should stick to that level of interest rates. It is the right level to reduce inflation.
Raffaella, I bring you and our global audience that sound to really just emphasize how much pushback they are getting from these fiscal governments, because this is a dynamic you see right now in the United States as well. The idea that the Federal Reserve is trying to remain hawkish while Biden administration, I would argue state governments even, are actively pushing back against that narrative. Raffaella, how much of the ECB is being led by the Fed here in terms of their approach?
I think they both trying to be very hawkish right now because they're afraid to lose even more credibility in the face of the market, given that the run-up of inflation, they miscalibrated. So I think they're both responding to a credibility puzzle. But that being said, I think the Fed is justified. There is a much stronger wealth effect and there's a stronger household demand today. So the Fed is correct in its stance, whereas the ECB really needs to guide the economy through this investment challenge. I mean, don't forget that the EU is trying to do green defense, nearshoring, especially recently. Eventually we'll need to do the rebuilding of Ukraine, digital transition. All of these transitions require very careful guidance to the private sector on what is the realistic medium-term cost of capital, which is at least 100 basis points below where they are today. So I think the ECB is missing the plot in the sense that the finance minister complain, as they always do, but they also pick up a real worry that the ECB is focusing too much on inflation today and too little on inflation in the medium term.
You say the ECB is missing the plot. I wonder if the Federal Reserve is as well. Raffaella, let's shift to our focus to that Fed decision on Wednesday, because often when we talk about tackling inflation, the focus shifts to commodities. And yeah, this oil rally doesn't seem to be lifting break-even pricing or bond pricing at all. In fact, it feels like the biggest inflationary pressure right now is coming from wages, from strikes. You're seeing this from the United Auto Workers and other unions across the United States and across the world as well. Talk to us about how the Fed should approach very sticky wages.
So I think realistically, the way the Fed can approach wages is to provide more analysis, guidance, and data on the granularity of the labor market, because the labor market is very diverse. And these days, the average doesn't really reflect what is going on. So when you say that average wages are rising, for example, the pay award offered in the automakers doesn't quite reflect the fact that the magnitude of the change is big, but the level of wages, especially of the less skilled workers, is so low these days that they really cannot afford to raise a family realistically in the US today. So the problem with the Fed is that to get real credibility with the broader public, it should be very realistic in saying these are the consequences. There is nothing more that they can do because it's not really credible that you will push the economy into a 2008 style recession, which is what you will need to push the unemployment rate high enough to be disinflationary. This whole decade will see the labor market very tight, wages rising. There is no way you can get out of it.
I mean, a historic moment truly around the world, especially when it comes to the labor market. Raffaella Tenconi of ADA Economics, we thank you, as always, for joining the program. Coming up, we go from monetary policy to perhaps a little bit more of what the government can do. The death toll from devastating floods in eastern Libya tops 11,000 in just one city alone. That comes as hope fade for thousands still missing. This is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. The death toll from devastating floods in eastern Libya has surged past 11,000 in the city of Derna alone. The UN estimates that more than 10,000 people remain unaccounted for in the city after a rare hurricane-like storm slammed into the North African nation last week. Almost a quarter of Derna's entire population are currently either missing or confirmed dead. We, of course, will bring you more developments as we get them. This is Bloomberg. Societe Generale slumps the most in 6 months as the CEO's first strategy update underwhelms investors. Oil pushes closer to $95 a barrel as OPEC plus supply cuts squeeze the market even further. Plus, stocks fall as traders stand by for a big week of central bank decisions from the U.S. to the UK, Japan, and around the world. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. The United Auto Workers president has rejected a pay offer from Stellantis as a strike at the big three U.S. car makers enters its fourth day. Workers at plants in Michigan, Ohio, and Missouri walked off the job on Friday in a partial strike that's threatening billions in losses if it spreads to more plants. For more, we're joined now by Bloomberg's Oliver Crook in Berlin. He's all over this story. Ollie, let's just start by getting a kind of check on where we stand right now with the strike.
Right. So this was all precipitated because GM and Ford put 20% on the table. Stellantis put in 17.5% raises. And the workers, they're asking for 36%. And we're just at a massive distance there. In terms of palpably what came out over the weekend, well, first you had Biden speaking on Friday, coming out on the side of the union, saying that basically that the profits that these companies have enjoyed have not been really shared adequately among the workers. So what did we get over the weekend? Really concretely, that one raise, right? Stellantis saying 21% is now on the table. Here's how the president of the union reacted to that offer.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies.
And we knew that there were some conversations with Ford on Saturday. There were some conversations with GM on Sunday. But really, we're still at a massive distance here. We're talking about a 15% differential that has not really moved the dial on day 4 of this strike. We're going to have it just going to continue to roll on.
Well, really pulling a page out of the Teamsters playbook, really an aggressive approach. Ollie, what comes next here?
So today, Monday, we understand that Ford and Stellantis are back at the negotiating table with the union today, so we'll watch for any news out of that today. Then also this week, we're going to get a White House delegation that is going to Detroit, led by Gene Sperling, the economic advisor, and Julie Su, the deputy and acting head of the labor market, really to try to help facilitate and support these talks. What comes next for the strike? We don't know, and that is by design. Sean Fain has kept it deliberately ambiguous to preserve the strongest negotiating position. It's a wide strike across 3 states, but a shallow strike. Only about 10% of the workers in the union are currently striking. They've hit high margin cars, but they haven't hit the real profit centers yet. So we're still awaiting to see if they're going to aim for those Ford F-150s, those Rams, and those Silverados.
Hitting America where it hurts, and it's ginormous cars, clearly. Does this spill outside of the auto sector, Ollie?
So what's interesting is that I think everyone globally will be watching this to a very large extent, right? This is in some ways very interesting and very material to the auto sector, yes, but this is a conversation that's going on globally in many offices. We can understand this very clearly because it's 150,000 people in a union. But as we go into the fall here in Germany, what we'll be watching is in October and November is when you get a lot of these wage negotiations. And of course, these wage negotiations are what is going to govern the path for inflation going forward. And so the question is, and it's one fundamental question everywhere, is how much power does labor still command, and how is that power distributed across different industries? We're about to find out in the auto sector, but we're going to find out in a great many other sectors for the few months to come.
And of course, now the White House headed to Detroit as well, I'm told. Let's see if anything progress comes out of there. Bloomberg's Oliver Crook all over that story. We thank you, as always. Now, when I think cars, we got to talk about oil as well. Oil extended an upswing as OPEC plus supply cuts tightened the market. It comes as the Saudi energy minister is due to address a conference on the kingdom's oil policy, as well as its view on net zero. Joining me now for all things commodities is Will Kennedy, Bloomberg senior executive editor for energy, as well as commodities. Will, before we get get into kind of the nitty gritty, there is a chart that I love this morning, and it really basically takes oil prices and bond yields and tracks them. The idea here simply being that oil prices were pushing up these bond expectations until the last month. What is the bond market getting wrong about the oil market right now?
Or what's the oil market getting wrong about the economy? I think what's happened here is that the oil price is supply driven and not demand driven. So in the earlier part of the year, a lot of people were interpreting the oil price as a commentary on where the global economy was, where the Chinese economy is, and that was very much in sync perhaps with the same conversation going on in the bond market. What we have here now is a concerted effort by OPEC Plus to assert a grip on the market to keep supply under control. They've extended those supply cuts until the end of the year. So now the focus of the oil market is very much on supply rather than demand, and supply happens outside the wider context of the global economy.
What about the pricing when it comes to refined products as well? What is actually driving what here? Is it the dog wagging its tail or the tail wagging its dog when it comes to oil and refined products like gasoline, like diesel?
So this is another thing that's very important about the oil market right now, is that the global refining system is looking pretty stretched. Through the pandemic, we lost a few refineries, and demand has come back very strongly since then, perhaps even stronger than some people predicted. And you can't use crude oil for anything. You need to turn it into fuel. You need to turn it into gas for your cars and jet fuel for your planes. And the global refining industry is working really very flat out to make that happen. That's widening the spread between some fuel prices and oil prices, especially for diesel, so important to how the global economy works, where we've seen some really strong diesel prices. So what consumers end up paying is perhaps even ahead of where the crude oil price, and we're seeing gasoline prices, although not approaching the very high levels we saw after the invasion of Ukraine, we're seeing gasoline prices at very high levels for this time of year, and that probably doesn't augur well for the months ahead.
I was going to say, or the years ahead. We've got a presidential election next year in the United States. That'll be quite interesting as well. Let's broaden this out, though, because the initial move, it felt like in oil last year, came from Russia's invasion into Ukraine. The conflict continues. How much of that is having an active effect in the oil market, but also broadly the entire commodity complex?
It's still a very important factor, but what we've seen is that the oil industry, the oil trading industry, has been able to adjust to the new facts on the ground. So Russian oil that would have previously gone to Europe is now very much going to customers in Asia. In fact, Russia appears to be finding new customers. We've seen several tankers go to Brazil in recent weeks, a new market for Russian oil. So people are having to work around the restrictions, the price caps. Perhaps Russia isn't getting as much money for its oil as it would have done in a pre-invasion world. But the world has adjusted, and the oil continues to flow, and the oil continues to find its way to the market.
If I only had more time, I would ask you how much exposure people actually want to this. But luckily for you, we're out of time. Will Kennedy, thank you as always for joining the program, who supports our executive editor for energy and commodities. Now, U.S. National Security Advisor Jake Sullivan and Chinese Foreign Minister Wang Yi have met over the weekend in Malta. Among the agenda items, a possible meeting between President Biden and Xi at the APEC summit in November. The Malta meeting comes at a critical time in U.S.-China relations, with Wang scheduled for talks with Russian officials in Moscow this week. Meanwhile, Germany's foreign minister says the European Union must reduce its reliance on China. Annalena Baerbock tells Bloomberg's Anne-Marie Hordern about how the region's strategy has changed thanks to the global fallout from the war in Ukraine.
We have learned our lessons from our Russian dependencies. And again, I believe it's a strength if you can be also in politics self-reflective of saying, okay, this was obviously not the right way to go. We had such a high dependence on Russian gas and oil, but especially gas, that obviously in the past former governments took decisions which weren't the right one. Speaking about the gas pipeline Nord Stream 1 as a purely economic thing, nothing to do with geopolitics. And I was in opposition back then, and I was also at the Yamal Peninsula, for example, where there was a source of this pipeline coming through. I spoke to many people there, and I could not only feel from our partners in Poland and the Baltics, but also there that this has obviously a geopolitical dimension. So before election, I was always arguing we have to not only trust on words, but we have to see the action. And now when we came in government, we said already in our coalition treaty that we have to rephrase our dependencies. We formulated also before the Russian war that we will do a new China strategy. And after the invasion, the full invasion, we not only wrote the strategy, but we prepared for the things we should change in the future. And this is like limiting.
Are you worried about Chinese retaliation?
Yes. So first of all, understanding that if you're bound too closely, it can endanger yourself, especially if you are having such a high dependency of a regime like in Russia, which is in the end attacking your own peace order. So therefore, cutting down our dependency from Russia, but also now with regard to China, de-risking is our total understanding of the strategy. No decoupling, because you cannot decouple in an interconnected world. And a connected world is also way to peace. But we should be able to defend ourselves, not being naive. And so being a partner in climate issues, being a competitor, obviously, with China with new technology, but also seeing that we are systematic rivals and we have to protect our own vulnerability, and this is where von der Leyen comes in, the Commission President, to strengthen our critical infrastructure in Europe, but also looking at outbound investment screenings.
German Foreign Minister Annalena Baerbock there speaking to Bloomberg's Anne-Marie Hordern as world leaders gather for the UN General Assembly Summit this week in New York. And tomorrow, German Finance Minister Christian Lindner will be speaking with Bloomberg Markets Today anchor Anna Edwards at the Future of Finance conference in Frankfurt. Terminal users can follow that conversation on LIVE Go on their Bloomberg terminal. And ahead of the UN General Assembly, Elon Musk has visited Turkish President Recep Tayyip Erdogan in New York. They've spent about 45 minutes discussing artificial intelligence and a potential Tesla factory in the region. SpaceX has also been working with Turkey's space program to launch communications satellites. Coming up on the program, public confidence in the Bank of England plunges to a record low. More on that story next. This is Bloomberg.
The big change we've had is a lot more fiscal discipline from the government. So that's a real plus. And I think I'd almost put that, ahead of the rest of the globe in that way.
What I see, and what I hope markets and businesses see, is a UK government that recognises the importance of sound public finance.
I think for every 100 days, maybe there's 5 to 10 days when the UK and the Eurozone can pull the US around.
Wonderful entrepreneurial spirit, great education. So I think in the long term, you would still have to put UK at the top of the list.
Bloomberg TV guest speaking about the UK's economic outlook on Bloomberg Television and radio. I want to stick with the theme of the United Kingdom because public confidence in the Bank of England has plunged to a record low amid soaring interest rates and elevated inflation. That, according to the central bank's own survey of household attitudes. Bloomberg's Lizzie Burden is here. Lizzie, let's start with the dismal review of the Bank of England. It's kind of coming within from its own house. Talk to us about what we heard.
Yes, exactly. It's the inflation attitude survey by the BOE. As you say, public confidence in the bank at a record low. When you think about it, monetary policy is a game of expectations management, isn't it? And the Bank of England seems to be failing miserably. 2 in 5 people think it's doing a bad job of controlling inflation. But it's also bad news for the Prime Minister Rishi Sunak because his #1 priority is to halve inflation this year, and yet he isn't promising to do anything actively towards that end. He's only promising not to worsen the problem. So really, his political fate is somewhat in the hands of the BOE. But we get another decision on Thursday. The expectation is for a 1/4 point hike. The question is what the guidance will be around it. Will it clearly be that this is the last hike? Are we at the peak of Table Mountain?
And speaking of surveys, some bad news from the BOE survey, but some good news from the MLive Pulse survey. Walk us through it.
Well, good news if you're Keir Starmer. It shows that the majority of finance professionals who responded reckon Starmer, the opposition Labour leader, would be better for the pound and better for the FTSE. So it shows what a long way he's come in terms of wooing the business community, what he calls the smoked salmon and scrambled eggs offensive, this version of Tony Blair's prawn cocktail offensive, because, of course, he's had to turn around the reputation from the time of Jeremy Corbyn, his predecessor. And to do that, partly, he's reversed the nationalisation plans and he's made ex-Bank of England Rachel Reeves his shadow chancellor, front and centre of his campaign at every moment.
Lizzie, we're about, I want to say 20 minutes away from hearing from Liz Truss herself, the former premier, of course. Is she going to cause some trouble in Downing Street?
Well, I was going to say, on that MLive Pulse survey, it also shows what a difficult time Rishi Sunak's got, turning round the ship from this time last year when you had Liz Truss and before that Boris Johnson, the reputational damage. Look, we've had a trail of this speech by Liz Truss. It doesn't look like we're going to get any apologies still. She's going to say we're expecting that we've had 25 years of economic consensus. That's why we haven't got economic growth in the UK. So to me, that sounds a lot like the blob that she was talking about this time last year.
I wonder what that head of lettuce she was compared to has to say about that. Lizzie Burden with that story. We thank you as always. I want to stick with the UK story specifically. Talk about one of its largest companies, the Burberry CEO, saying tourists are spending more on luxury goods in mainland Europe than the UK following the loss of tax-free shopping for visitors to Britain. Jonathan Ackroyd spoke exclusively to Bloomberg's Francine Lacqua ahead of Fashion Week.
How's business in the UK doing?
Business in the UK, obviously it's our market. So we've just opened our fourth store in London. We've just renovated our store in Bond Street, which is fantastic, super exciting. Yeah, we're very positive.
Your chairman has had a go at the government for actually not helping luxury companies or retail companies out more with VAT refunds. Are you missing out?
Well, we're not missing out. I mean, overall, globally, our tourist sales have obviously been increasing in the last couple of years, which is a positive. So that's a good trend. Unfortunately, there is a gap between our tourist spend growth in mainland Europe versus the UK, which is disappointing, especially as it's our home market. So we'll keep communicating that. We think probably post-Brexit, it would have been an opportunity. It would have been an opportunity to bring more tourists in. So we hope that sometime soon things will change.
Will the government listen?
I hope so. Well, we keep talking. It's not just us as well. I think there is a big movement to keep communicating about the frustration of it. But we're also concentrating on celebrating our brand here in London Fashion Week as well. So still lots to do.
Jonathan, are you missing the Chinese tourists in London, or are they spending elsewhere, or is it really a loss of revenue?
I wouldn't say we're missing them. As I said, generally our tourist growth has been impressive globally, so it's just spreading around globally. So, even into the UK as well.
So, when you look at pockets of growth, where are you doing especially well, like regionally?
Regionally, well, our quarter one results that we communicated in May, we showed good growth in Europe. So Europe has been strong. Also very positive in Southeast Asia, APAC, and China.
Burberry CEO Jonathan Ackroyd there speaking to Bloomberg's Francine Lacqua ahead of London Fashion Week. Coming up, we dive into the markets. There's a lot going on. We've got the Fed, we've got the BOE, we've got the BOJ, and that's just the top three. We've got a ton more. None of that is going to come on where inflation is actually leading it. Do oil prices really matter? Do gasoline prices really matter? That's going to be the question. We're going to ask Eddie van der Walt. He's kind of a little bit an expert in these matters. Stick with us. More coming up. This is Bloomberg. Welcome back to The Pulse. I'm Kriti Gupta in London. Now, stocks have slipped before a major week of rate decisions as oil ticks a little bit higher. There's a lot going on in markets right now. Who better to help us digest it all? Bloomberg's MLive's Eddie van der Walt, Deputy Managing Editor, joins me right here on set. Eddie, there's a lot going on in central bank decisions. You got the Fed, you got the Bank of England, you've got, I think, Norges Bank, I want to say Brazil. And before you rant about all of them, let's talk about the BOJ, because I think this is a really significant one. You're starting to see this idea that perhaps the BOJ might normalize, might get on the same page as the Federal Reserve. Is that a realistic expectation?
Yeah, the Bank of Japan, of course, is still very much, behind the curve, behind everybody else, with policy rates still in, deeply negative territory on a real basis. There is hope that they will look towards normalization, or that they might do something, on curve control. There's a lot that the Bank of Japan could do, and I think they are a wild card this week, but they are also very far behind the curve, and I don't think that they will shift the narrative globally. I think this will be a Japan thing if they move. I think that could have implications for the dollar, and therefore shift the market narrative globally, but I don't think that it necessarily will be an indicator of where the rest of the central banks are going to be.
Well, I think what's really interesting is the way it's getting priced into the market here, right? Because we're talking about kind of everyone saying, well, it's the BOJ. They'll never really act on whatever they're kind of indicating, even though, to be fair, Governor Ueda didn't actually say he was going to do anything. He just said it might be an option on the table, which, to be fair, Chair Powell and President Lagarde have said that plenty of times as well. Well, there's a terminal chart I want to show you here where yen swaps specifically in the FX market have already jumped the gun. They've already said, look, that higher rates are going to happen in Japan, and that is sticking. How much of a dislocation in the FX market is going to have ripple effects everywhere else?
Yeah, look, we saw that last time, right? We saw even on Ueda's comments, whenever he even talks about tightening, whenever they talk about policy normalization or lowering the amount of curve control, allowing their 10-year yields to rise above the 1% level, whenever we hear those sorts of things, it has an impact because you've got a lot of Japanese money sitting in other markets, and if that starts to come home, that will move FX, that will move the dollar. If you move the dollar, you are moving everything across markets.
Yeah.
So it is a really, really important, just pressure point for global markets, I think.
Yeah, 15 seconds. Do you think that all those people who are shorting those JGBs are finally gonna make that quick buck?
Oh, that's a big call. I don't know. I think I would much rather look towards the dollar at this point and see, whether that rally that we've seen in the dollar is perhaps not coming to an end, because I think there's a lot of people who are shorting the dollar and might get themselves caught out here.
I mean, it's really fascinating because then on top of that, you also have the oil story, which is going to impact import prices, push inflation higher. We could go on and on, talk about the domino effect, which you taught me how to do. Eddie Vanderwald getting a taste of his own medicine. Bloomberg's M Live, thank you as always for joining the Pulse this morning. Now, up next, our brand new show debuts. Bloomberg Brief. The U.S. is waking up. Europe is already trading. Danny Berger is in London. Manus Cranny is in New York. The original Daybreak Europe crew are going to give you everything you need to know for our New York audience and for our European audience as well. You don't want to miss it. This is Bloomberg.